Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm back with another weekly economic review, this time for the week ending December 10, 2021. So I'm still going to be talking about inflation today. That's still a topic of the hour. And the Omicron variant, it seems that we've had some good enough news this week to calm the markets down. So we'll be discussing that in a few minutes, but it seems that maybe the cases are not as severe or even less severe than other variants. And maybe a third vaccine dose will help protect everyone from it. So that was enough for the market to rally, pretty much erased all of the losses. So we'll be taking a look at that in a few seconds. So let's get right to the numbers now. Okay, so weekly returns were negative for bond. That means that we have higher interest rates. So more of a risk on tone in the market, more of a relief, and good returns also for equities. US leading the way, but the TSX still up 1.5% after 4 days, so a very good performance. Price of oil rebounded by 7%. The Canadian dollar rebounded by 1%. So we erased some of the losses from the previous weeks following at least the Omicron variant announcement. So inflation. I need to talk about inflation again because it was inflation day to day on a Friday in the US, the highest level since 1982 for inflation. So we're at 6.9% in the US for inflation. In Canada, we'll have the November figure next Friday. So the US, this is for November. In Canada, we're still stuck with the October figure in this chart, but next week we'll have the figure. So if we look at the contribution from all of the components in the US, sorry if the legend is pretty small on the bottom, but the light shade of blue that you see that explaining more than half of the inflation figure right now is transportation costs. So that includes price of gasoline, which have been rising very strongly over the last 12 months. Remember that inflation is the change in the level of price over the last 12 months. So November 2021 compared to November 2020. In 2020, we're talking more about the deflation and economic issues. So we had a strong rebound in the price of gasoline, which means that next year, when we slowly move into next year, the comparative between 2021 and 2022 will be less favorable to inflation. So we should start to see headwinds for inflation and an inflation rate starting to taper off because of those base effects in gasoline and also used car prices. I've mentioned a few weeks ago that used car prices have been up by about 50% since the beginning of the pandemic. So as production comes back online for new cars, it's going to be easier to find a new car, so less pressure for used cars. So at some point, this should also be a headwind for inflation. So maybe we're getting near the peak of inflation here, but there's still a lot of uncertainty about 2022 supply chain issues. There's a lot that we don't know. So what we can do right now is look at surveys. So this is a survey here from Oxford Economics, and it's interesting because they surveyed people that cover almost 100% of the world GDP, so everywhere around the world. So the consensus seems to be that either the peak of disruption is either behind us already or pretty much we are in it right now. So in Q4 2021, this is the peak supply chain disruptions that we might see. So this is a survey, this is only opinions, but I mean, this is what we get from around the world. But after that, even if we're at the peak, after that, we need to come back to normal. So we're going to have these effects lingering on through the year. And as you see, many surveyed economists here think that this is going to be lingering all the way to Q3 or Q4 of 2022, even maybe in early 2023. So it will take a long time before we return to normal. So very uncertain environment. That's why we'll be talking about inflation again for a few months still. In Canada this week, we had a very interesting report that, the forecast is that inflation at the grocery store, so food inflation, should reach about 5 to 7% in 2022. So here on the chart, you have food inflation from Statistics Canada, so year-over-year price change as of last October. As you can see right now, inflation is running at 3.5%. So there is inflation at the grocery store. I feel it, I'm sure that you feel it. But if in 2022 we have 5 to 7%, well, if you look at the chart, Last time we saw something like that was coming out of the great financial crisis of 2008, 2009, and it's a pretty rare occurrence because we haven't seen any other environment like that since the last 30 years, besides this little period here. So that means $1,000 more if when you buy food for the year. So that's $1,000 less in your pockets at the end of the year, and you haven't bought anything more. You're just still buying the same basket of goods for the average family of four. So that means in economic language that your discretionary spending, it will be down by $1,000. So you have $1,000 less to spend on other things. So that's kind of a tax on your standards of living. So very important development here. So we'll be following that to see if it comes to fruition. But this is a very, very good tangible example of why inflation matters, because it reduces the standard of living. It destroys demand. So very important example here of why we should care about inflation and why we talk about it so often here in these videos. So financial markets this week, well, last 2 weeks even here. So this is the S&P 500. So when Omicron was announced in late November, pull back in the market, volatility, and then some preliminary but good news for regarding Omicron, regaining everything, and it's now pretty much priced at. So that was quick. Is the market right? We don't know. The market is the market, but we need to have the answers from science and not from the market here. So, but so far so good. It seems that, as I mentioned earlier, cases are less severe. Vaccines should work. It's not clear, but should work. So the market is seeing that in a positive light. But what's really going on underneath the market is the buy the dip mentality still alive. So here's a chart. US retail investors, so the volume, the retail net buys, well, that was the largest retail flow on record, so going all the way to the beginning of the pandemic. So retail investors bought the dip very aggressively, so the buy the dip mentality remains very much alive. We see that as a reason to be neutral because you can be too pessimistic. It seems that even though there are some risks out there, retail investors seem to be buying the dip and keeping the market afloat. So we take that into consideration. But also, if we do have very negative news and we do have very strong volatility and a strong pullback in the market, maybe the behavior of retail investors could flip and rush for a door, and maybe that's going to be accelerating the next downturn. So that's why we'd like to remain more neutral with an eye towards defensive strategies, even though we're not defensive yet. So this is what's happening underneath the hood. But we find very interesting too that at the same moment that everyone's buying the dip, well, here the flows for the TLT ETF, which is a US-based ETF, exchange traded funds, that holds the longest dated treasury bills in the US, so bonds of 30 years, well, 20 years plus technically, but there's a lot of 30-year in there. The most defensive asset that you can hold. So at the same time that everyone's buying the dip, everyone's buying a lot of protection in the case that you're wrong. So that tells you a lot. So it's not a high conviction move, it's more risk management. So we're in that mood. We see that we think risk management is the key, protecting the downside, but also following the wave to the upside. That's the kind of strategy that we think makes sense right now in the markets. So that wraps it up for the week. ia.ca/economy. You have the Economy and Finance 101 section. We will be adding more content early in 2022 and through the year. If you have any suggestions, we're always takers, so don't hesitate to send them to us. Twitter, you can follow me there, and on LinkedIn, you can connect with me if it's not already done. And I'll be posting the PDF version of these presentations every Friday following the recording, so you can have access to the presentation there. So thank you, everyone, and I'll see you again next week.